Before we go any further, it's important to reframe what just happened. This wasn't fundamentals. This wasn't a macro shift. This wasn't a narrative resolving itself. What you just witnessed was forced behavior inside a rule-driven market. Leverage met liquidity, and price reacted the way it always does when it's pushed by obligation instead of choice. If what you felt was nausea or confusion, that response makes sense. Those reactions don't come from information. They come from watching forced liquidation. This environment is designed to make you stare at every tick. That's not psychology. That's structure doing its job. And now we are entering a window measured in weeks, not months, where the next phase will be decided. In a minute, I'll show you the one signal that determines whether this damage stabilizes into a base or cascades into a final leg. The market didn't speak this week. It flinched. To understand what actually happened, we have to separate the event from the cause. The event was price falling. The cause was structural. Silver is still discovered primarily through futures markets, not through the physical exchange of metal. That means price is shaped first by leverage, positioning, and hedging behavior before it ever reflects supply or demand. When positioning becomes dense and sensitivity to margin increases, even modest movement stops behaving linearly. A small push no longer produces a small response. It produces a chain reaction. As volatility expanded, margin requirements effectively rose in real time. That increased the cost of holding exposure. Some participants adjusted, others couldn't. That's where the cascade begins. Positions are reduced, not because someone changed their outlook, but because they are required to reduce them. Those reductions force dealers to hedge. Those hedges pressure price. That pressure raises volatility again. And each turn of that loop removes more discretionary bids from the market. That's why price moved faster than sentiment could keep up. There was no debate happening. There was compliance. This is what reflexive selling looks like. Selling that generates the conditions for more selling. And when that loop starts to dominate, it doesn't push price through support. Price didn't fall through support. Support stepped away. What made this feel violent wasn't the drop. It was what vanished. And in a moment, we'll isolate the exact pressure point that caused those bids to disappear. Why it felt violent. Forced selling plus. Liquidity. What made this episode feel violent wasn't simply how far price traveled. It was how little resistance it encountered on the way. In a normal market, liquidity absorbs emotion. Bids and offers stack. Negotiation happens. Time stretches. In a forced market, liquidity retreats. And when liquidity thins, every order carries more weight. Forced sellers don't negotiate. They liquidate. They don't wait for levels to prove themselves. They hit what is there, because what matters is compliance, not price. That's the critical difference between voluntary selling and margin-driven selling. Voluntary selling is expressive. It reflects opinion. It moves with friction. Margin-driven selling is mechanical. It reflects obligation. It moves through whatever is left. When deleveraging begins, charts don't just move, they compress. Hours of positioning unwind in minutes. Weeks of structure vanish in sessions. What looks like panic is often simply accumulated leverage exiting all at once. As that happens, stop clusters are triggered, which creates new market orders. Options hedging intensifies, which adds non-discretionary flows. Those flows collide with thinning books and what forms are air pockets, zones where price doesn't trade so much as relocate. That sensation people describe as a flush or a waterfall is often just the sound of bids stepping away faster than sellers can finish. This environment is psychologically disorienting by design. It removes narrative, it narrows time horizons, it trains attention onto every tick. That nausea, that screen watching, that urge to interpret every candle as meaning, those are not signs of weakness. They are symptoms of watching forced behavior unfold. And it's precisely why volatility tends to peak near structural turns. Trends are orderly, inflection points are not. There's a tell that appears only when forced selling is exhausting. And later, we'll cover the paper versus physical split that price alone cannot show. Because violence in price is usually silence in liquidity. Facts versus interpretation. Credibility ladder. Before we can place meaning on what just happened, we need to separate what can be observed from what can only be inferred. Fact. Volatility expanded rapidly. That is measurable. It tells us the market entered a stress state. Fact. Price moved through multiple reference zones with little consolidation. That tells us auctions were incomplete. Fact. Open interest behavior changed. Whether it rose or fell matters less than the fact that participation was forced to adjust. Fact. Correlation spiked. Assets that normally breathe independently began moving together. That is what markets do when liquidity becomes the dominant variable. Everything beyond that is interpretation. One interpretation is leverage unwinding. Another is demand deterioration. One interpretation is that short-term control has shifted. Another is that long-term structure remains intact beneath the damage. Those interpretations carry very different emotional consequences. An emotion is where most positioning errors are born. The separation matters because facts anchor you. Interpretations tempt you. Facts tell you the terrain. Interpretations tell you stories about where the terrain is going. Both are useful, but they are not equal. One fact here matters more than the rest, and we'll isolate it. Next, we place price into its actual decision zone, because facts describe the terrain. Interpretation decides whether you run or observe. When markets come out of a forced event, they don't immediately offer direction. They offer a decision zone. And a decision zone is not a number on a chart. It's a behavioral range. It's the area where the market reveals whether liquidation pressure is being absorbed or whether it is still propagating. This is where auctions either begin to rebuild or fail to form at all. Inside the upper band of this zone, the dominant question is whether forced selling is losing control. You don't look for excitement there. You look for stabilization, narrowing ranges, slower reactions to bad news, price discovering where two-sided trade can exist again. If that process begins, it suggests liquidation is being met, not extended. In the lower band, the behavior is different. Continuation dominates. Bounces struggle to attract participation. Liquidity remains selective. Each attempt to stabilize is brief and easily displaced. That environment doesn't resolve emotionally. It resolves mechanically through either exhaustion or escalation. The distinction between absorption and continuation is not philosophical. It is structural. Absorption looks like time returning to the market, rotations, failed extensions, volatility that can no longer expand on command. Failure looks like time collapsing again, single directional sessions, volatility that responds instantly to pressure. This is why days are less informative than weeks. Decision zones are not crossed. They are tested, and tests take time. The more compressed the liquidation, the longer the market typically needs to determine whether it was corrective or preparatory. If stabilization happens without participation, it means something very specific. The physical market will either confirm or reject what paper is implying. Decision zones don't forecast. They expose. Paper versus physical, premiums, inventory, delivery, real-world tells. When price is being discovered primarily through paper contracts, charts can only tell you what leveraged participants are doing with claims. They cannot, by themselves, tell you what is happening to metal. That distinction becomes critical after forced events because paper reprices instantly, while physical markets respond through friction. Premiums, availability, and delivery behavior move slower, but they speak more honestly about stress. In a normal environment, premiums compress. Retail and wholesale pricing track futures closely. Inventory changes reflect logistics more than urgency. After a forced episode, that relationship often distorts. Premiums can hold or rise even as futures fall, not because sentiment improved, but because supply is no longer meeting immediacy. Retail spreads widening relative to wholesale tells you something different than wholesale spreads widening relative to exchange price. One reflects distribution strain. The other reflects sourcing strain. Inventory data also matters, but not at face value. A draw can mean metal is leaving the system. It can also mean metal is moving within it. Shuffles and reclassifications change numbers without changing stress. What matters is whether metal is being demanded for delivery or deferred through rollover. When delivery interest rises into weakness, it suggests paper participants are testing whether claims can still become metal. When rollover dominates, it suggests the system is still choosing promises over possession. Structure shows up in curve behavior as well. Backwardation is not bullish by itself. Contango is not bearish by itself. What matters is whether the curve is reflecting convenience or constraint. Real-world friction is the final layer. Delays, product mix thinning, substitution. These are not headlines, they are tells. This is where price narratives usually fail, because charts cannot measure inconvenience. There is one physical tell that always appears before structural turns, and it is why divergence matters more than direction. Paper moves fast, physical moves true. Scenario map. Breakout versus fakeout versus washout. From this point forward, the market is no longer in explanation mode. It is in resolution mode, and resolution never arrives as a single outcome. It arrives as a narrowing of probabilities. That's why it's more useful to map conditional paths than to argue about direction. What matters now is not what anyone hopes happens, but how the system behaves if certain conditions begin to appear. The first path is what most people intuitively label a breakout, but structurally it begins as something quieter. Stabilization above the decision zone, not excitement, not headlines, time returning, ranges narrowing, price responding less violently to stress. In that environment, open interest can begin to rebuild without price being damaged by it. Participation returns, but volatility does not. That combination matters. If premiums remain firm or quietly expand while futures stabilize, it suggests forced sellers have largely exited, and remaining flows are becoming discretionary again. That doesn't confirm upside. It increases the probability that liquidation pressure is no longer dominant. This path is invalidated if every attempt at stabilization is immediately met with expanding volatility and renewed structural weakness. The second path is the one that traps the most emotion. Price recovers, but participation does not. Rallies look convincing visually, but open interest lags or contracts. Volume fades instead of builds. Physical indicators stall rather than tighten. This is the relief rally scenario. It often feels powerful because it arrives after pain, but mechanically it is hollow. It reflects short covering and positioning repair more than new engagement. In this environment, the market can appear calm while remaining fragile. This path is invalidated if participation returns in a way that price can absorb, or if physical stress indicators begin to lead rather than follow. The third path is the most uncomfortable and the least discussable during it. Another volatility event, another margin adjustment, another moment where liquidity briefly disappears again. This is not continuation. This is exhaustion. A final sweep that compresses positioning, sentiment, and time into a smaller and smaller space. When it occurs, it often coincides with extreme narrative certainty and extreme emotional fatigue. If physical tightness appears into that weakness rather than after it, it suggests the system is undergoing a structural reset rather than a trend extension. This path is invalidated if stress dissipates without needing another mechanical purge. These are not forecasts. They are response maps. Only one of these paths creates speed. And the next section is about surviving all three. We don't predict outcomes, we prepare responses. After a forced event, one of the most important distinctions to make is between exposure and obsession. Exposure is structural. It reflects a view about the world. Obsession is reactive. It reflects what volatility is doing to your attention. And volatility's first objective is never price. It is focus. It pulls perception inward. It shortens time horizons. It conditions the nervous system to interpret movement as meaning. That is why tick watching feels productive during stress, even though it usually degrades decision quality. Liquidity events don't resolve in candles. They resolve in behavior, in participation, in whether time returns to the market or continues to collapse. Price is only one expression of that process. Time is the other, and time is usually the more honest one. When decisions are built around candles alone, they are built around noise. When they are built around evidence, they are built around whether the system is healing or still dislocating. This is also where risk discipline quietly separates from market commentary. Respecting liquidity events means accepting that there are periods when the most intelligent action is not reaction. It is observation. It is allowing the market to show whether it can absorb, rather than demanding that it perform. Patience is often framed as inaction. In reality, patience is a position. It is the decision to let structure reappear before interpretation hardens. This channel exists to support that discipline, not to supply answers, not to time outcomes, but to build frameworks that reduce the probability of emotional error during structural change. This is education, not instruction, and it is most valuable when volatility is trying hardest to replace thinking with sensation. Next, the exact checklist I'm watching over the coming weeks. We measure, we don't gamble. From here, attention shifts away from what already happened and toward what the system reveals next. The first thing to monitor is volatility itself, not direction. Behavior, whether it begins to contract on its own or whether every attempt at stabilization is met with renewed expansion. Volatility that cannot calm is a sign that forced flows are still active. Volatility that compresses without narrative support suggests liquidation pressure may be exhausting. Alongside that sits open interest. Rebuilding participation without renewed price damage implies discretionary involvement returning. Continued draining implies the market is still in reduction mode. Neither is bullish or bearish by itself. Each simply tells you who is still being forced. Margin rule changes matter because they alter the cost of existing exposure. They don't create trends, but they can accelerate resolution. Exchange inventory behavior adds another layer. Whether metal is leaving, being reclassified, or simply rotating between categories tells you something very different about stress. Delivery demand is even more direct. Rising interest in taking metal into weakness suggests questions are being asked about paper reliability. Declining interest suggests the system is still comfortable rolling promises forward. Physical premiums and delays translate that behavior into the real world. They show whether price weakness is producing ease or inconvenience. Liquidity during quiet sessions is another tell. If markets struggle to hold levels when volume thins, fragility remains. If they stabilize when attention fades, structure may be returning. Correlation shifts also matter. When everything moves together, liquidity is in control. And when assets begin to separate again, discretion is returning. The next 14 to 21 days carry disproportionate information because they sit directly inside the resolution window. That doesn't mean a move must occur. It means signals will align or diverge. And alignment is what produces speed. To avoid being psychologically front-run, anchor attention to these behaviors rather than to intraday swings. If two of these align, the next move usually isn't small. Signals whisper before price speaks. As we close this briefing, it's worth returning to where we started. This was not a fundamental story, it was a mechanical one. Forced behavior inside thin liquidity, a system reacting to pressure rather than opinion. And now that pressure has created a decision window measured in weeks, not months, where the next phase will be defined less by headlines and more by whether structure can return. What happens next will not be revealed by commentary. It will be revealed by signals. That's why I want to hear from you. Which signal are you watching most closely right now? Is it volatility behavior, open interest, delivery demand, premiums, inventories, or something else entirely? And which of the scenario paths feels most probable to you at this moment, and why? Not what you hope for, but what the evidence is suggesting. If these briefings help you frame volatility without being pulled into it, make sure you're subscribed. This channel exists to track structural shifts as they unfold, not after they've already been labeled. The next briefing depends on whether this window resolves or ruptures. And if another rule change hits while price stabilizes, the next move may be faster than the last.